Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. I have a very special treat for this video, this Monday video that we're doing today. I'm going to be covering the gaming industry and the gaming sector at request of subscribers, I might add. But, you know, there's kind of a generation gap with that. You know, I've never really played any of the games for any of the companies we're going to be covering here. So what I did was I invited my son, Colton. Colton, say hi to everybody.
How's it going, everybody?
Good. And Colton, I graduated from University of South Florida, degree in finance. A few words about him. He works with, helps me with our money management side business, but he also is spearheading the coordination of the developer team as we're working real hard to get our new version of FastGraphs out, and we're getting real close to having that done. And if he wants to, he can make some comments on that. But what I thought I would do here, you know, I'm going to go over the companies that we're going to be covering in this video, the gaming stocks. But, you know, again, I don't have any personal experience. In the words of Warren Buffett, you know, you really need to know your companies, know your businesses, and try to understand them as best you can. So although these are not necessarily my cup of tea, I do think there's some interesting stocks here. And some of you that are a little bit younger, or some of you who understand the gaming industry better, might want to take a look at. So in the spirit of that, I've had Colt come in, and we're going to talk a little bit. I'm going to let him introduce us to the gaming industry, how it works, how it makes money, and why that, you know, this actually is a growth industry, because I do consider these growth stocks. Colt?
Thanks, Chuck. So with the gaming industry has changed over the last decade significantly. Originally, what the gaming industry used to look like, and in order to make AAA video game titles, companies would spend tens of millions of dollars, if not up to hundreds of millions of dollars, developing and marketing these gaming titles. Just to name a few of them, EA DICE spent roughly $100 million US producing Battlefield 4, which is an extremely popular first-person shooter. FPS is what they're known in the industry. That was released in 2013. And Rockstar spent roughly $265 million US producing and marketing Grand Theft Auto 5 back in 2013, which is another extremely popular video game that is still played to this day. So the video gaming industry's main issue was the high cost of video games required a constant need for companies to create and release new video games on an almost yearly basis. This could cause many issues for the industry as a whole due to things like rushing production and not releasing polished video games, and even running out of creativity by needing to reinvent the wheel over and over again, which would ultimately lead to stale video games that do not keep users captivated. Over the last decade, though, companies have been creating what they call DLCs, also known as downloadable content, that the user needs to pay extra for after they've bought the video game in order to access it. These are like expansion packs to the games that are given at a lower cost, so the users have more content to continue playing the same game, and those are roughly $15, $20 for each DLC that the company comes out with. And the good thing about this is that this started to give companies a continued source of revenue, instead of like the movie box office model where they would release a video game and have a couple months of high earnings off of that and then have to start the process all over again. So DLCs began to solve the issues that the video game industry was facing. So to show some numbers, since 2010, there's been a major shift in how the industry has generated revenue as a whole. Roughly 20% of the revenue in 2010 was from in-game purchases, whereas 80% is what they called premium purchases, or purchases from premium games, meaning most of the revenue came from the users actually spending money on buying the video games, which were priced at roughly $50, $60. In 2015, 5 years later, that switched to about a 50-50 split. And then now, as of last year in 2020, that revenue split has shifted almost the exact opposite, where these companies are generating most of their revenue from in-game purchases versus the premium game sales. And so over the next 5 years, the in-game revenue is expected to be roughly $200 billion as a base case scenario to roughly 350 billion as an industry for the industry as a whole, as most companies are quickly switching to the trend of recurring revenue generated within these games. There's actually been a large shift as well to what they call free-to-play games. So instead of companies releasing a video game for $50, $60 and then creating DLCs, what they do is they actually release a video game that is completely free to play, and the only way that the company makes money is through in-game purchases like DLCs or skins. They call these things skins, which just are things that make the video game characters look cooler and things like that. So a lot of these super, super popular video games are starting to generate massive amounts of revenue, all from being a free-to-play game. One of the most popular video games in the world is called League of Legends, and that is their entire business model. And there's been another recent video game that's a free-to-play called Call of Duty Warzone, which they've approached a similar model. It's a completely free-to-play game with their only source of revenue being from in-game purchases. That's roughly what the video game industry looks as a whole. So, in summary, we've already started to see a massive switch to this in-game recurring revenue that almost acts like, I don't want to call it a subscription service because it's not a monthly subscription that these people are paying to play these video games, but it is a source of revenue for these companies to continue to generate money hand over fist for games that have been released for 5 years and plus now. So I think that's roughly all we need to talk about from the video game industry. And I'll pass it back to Chuck to talk about the video games companies themselves.
Thanks, Cole. That was excellent. I think even this old dog starts to understand a little bit how the gaming industry works after that presentation. So what we're going to do with the rest of this video is we're actually going to look at 7 of the premier gaming stocks out there. So let's go ahead and look at the portfolio review that I built in Fast Graphs here. And what you've got is 7 names. You got Take-Two Interactive, Zynga, Electronic Arts, Activision, NetEase, Nintendo, which I was asked to talk about, and then I think it's Roblox is how you pronounce this one. I'm going to be primarily focusing on 4 or 5 of these names, and I'm going to kind of briefly cover some of the others. But as we look at their numbers, when we get into looking at the individual stocks, I think you'll be able to see in actual numbers and graphically how these companies actually have made this transition that Colt was talking about. So I've kind of got some of these stocks keyed up here. Let's start. One of the newer ones out there is this Roblox. And the thing I think I want to point out here, I don't know a lot about this. I'm not going to get into a lot about it, except to point out that it was a recent IPO. It came out in March of 2021. You could see, like most IPOs, it had a huge surge. And then more recently, the stock price has been kind of weak. The company's losing money, but they're reducing their losses. And let's see if we even have, even forecasts are kind of iffy on this stock. So there's not a lot to look at fundamentally here, but it is kind of an interesting stock. And it's got a lot of traction with a lot of viewers. And what I'd want to do is just very quickly go into the company's website, since I can't show you a lot about fundamentals here. And, the company is working, they're creating these kind of, do-it-yourself games. What they're doing is they're bringing the world together in their own words through play. We enable anyone to imagine, create, and have fun with their friends as they explore millions of impressive 3D experience, all built by a global community of developers. So they're letting the developer get involved in building the games themselves. So it's an interesting niche, if you will, and, we're looking at it in the future. I think it was one that I wanted to mention because at some point, this would be one that you might be wanting to pay attention to. I just think it's too early to be talking about it much as an investment. Now, I want to go through Nintendo here because Nintendo was one that I was asked to cover, and it's actually one that I wouldn't have covered if I hadn't been asked, to tell you the truth. But I do want to go through some of the things Colt talked about. Nintendo was originally, I do remember, going back and probably even back further than 2002, when the Nintendo machine and the Sega machines and so on, they were very popular, and they were selling the hardware, then also selling a lot of games to go along with that. And we had a nice growth spurt, but then you can see the industry started to change dramatically as online began to take off. And here you see this, shift, if you will, from around 2010, 2010. And this company has a March fiscal year. And you can see the stock price of Nintendo languished for years and years there. Now they started to grow again, and they did have nice growth going from March of 2015 through, 2021, they're expected to grow. And again, this has a March fiscal year. Next year, or this fiscal year that we're in, we're anticipating a negative 12% growth, and then followed only by 4% growth. And if we look a little further out on estimates, analysts are expecting the growth of this company to actually be negative 11% over the next 2 or 3 years on average. And I'm not really getting a 3 to 5 year growth rate. So the reason I bring all this up is if you look at this company from a statistical point of view, you've got a PE ratio under 14. You got an earnings yield of over 7%, which I like at least 6.67 or higher. You've got a growth rate that's averaged 8.6% and a dividend yield of 1.6% that has grown over the last 5 or 6 years pretty consistently. It went from 10 cents a share in fiscal 2014 to 14 cents, and then it did fall to 13 cents, then 36 cents, 50 cents, 72, 98, and then 256 and expected to be down again. So it's not real consistent, and that's not one thing that you could say about this stock. So perhaps the money's been made. I believe the stock looks attractive statistically, but this would be one that I'd be very careful with in watching the fundamentals, because the fundamentals do not look very intriguing over the longer term here. The next one is Activision Blizzard. And, Activision Blizzard owns some of the largest and most well-known video game franchises, as Colton was talking about, including Call of Duty, World of Warcraft, StarCraft, Diablo. And like its peers, the firm is focused on engaging users beyond the initial game sale via extending the monetization window by expanding the use of multiplayer options and then releasing the downloadable content that Colton talked about. More recently, Activision has faced continued fallout because the company did have a widespread sexual discrimination and harassment and misconduct at the firm. And it was specifically, most of it, I guess, was in the Blizzard portion of Activision Blizzard. As a result, employees staged a massive walkout on July 28th of this year. And, it was not only about the culture problems at the firm, but also the tone-deaf responses of senior management, according to a lot of the employees. And immediately after the lawsuit was made, the CEO and head of human resources for the Blizzard division was forced to resign. I think he did that in the first week of August. But regardless of all of that, I think it's important to look at this stock fundamentally. The historical growth of this company has averaged over 20%. It clearly has one of the better growth records of any that I'll be showing you here. And like you would expect, you see the stock price, which is the black line on this graph, tracked earnings. You do see periods of overvaluation and extended periods of undervaluation, but eventually, the price moves into alignment with the orange line. Now, for a lot of periods of time, because the market has valued this at a premium, the normal PE ratio looks high. But I do want you to focus on this a little bit. It's only been high for the last several years. I mean, all from coming out of the recession, the Great Recession, we were looking at the PE ratio of the stock in the 12 and 14 range. The PE is now 21. The growth rate's 20. The PE of this orange line is P equals growth rate, if you will, representing a 20 PE. But now, here's the problem. Looking at all this, it all makes a lot of sense. The stock was overvalued. It looks like it's coming into attractive valuation now. But watch what happens as I evaluate what's been happening to growth. I do that by shortening the time frame. I drop this to 15 years. Now the growth rate's only averaged 12.21%. It's quite a different picture. And the overvaluation even looks more stark. And the current correction does not look as attractive as it did when I looked at it from a longer term point of view. I shortened the time frame again. I get a little pop in growth. I'm back up to 17% growth. So the point is, this stock is a double-digit grower, and it's consistently done that, but there is a little bit of oscillation in that growth. So let's look at what the future is expected to be. On forecasting, the analysts on the 3-year 5 to trend line forecast expect about 13.35%. I'm going to check that against Yahoo estimates real quickly here for you, because this is just to have another check. They're saying 13.9. So I would call that a consensus, 13.3 to 13.9. We'll call it, approaching 14% growth. That would make this stock overvalued at these levels, but because it's double-digit growth, if it actually reverted to the intrinsic value PE of 15, which is what this growth would essentially indicate, you'd be able to make about 7 or 8% a year. If this traded at the 21 PE ratio that it currently trades at, if it held that PE, you'd be able to make about 14%. So there is some growth potential here. Now, when I look at historical performance, I'm going back here, from December of 2013 to 2021, and you see, 21% annualized rate of return, capital appreciation, add in some dividends, you get to 21.8, almost a 22% annualized rate of return, which is significant compared to what the S&P 500 did. And I do want to remind you that the S&P 500 is really extremely overvalued here today. So, this stock is overvalued as well, if you will. So, there's an apples to apples comparison there. But anyway, this is a very, very interesting company. Now, later, I'm going to go through some of these main companies using the new version of Fast Graphs because I can move through the metrics very quickly because I want you to look at some of the other metrics, but we're going to stick with operating earnings here for now. The next one is Electronic Arts, and this is another good example where you see how the business has morphed and transformed. The growth rate here was 12.8% going all the way back to 2001. I shorten that to coming out of the Great Recession. I'm up to 13.7%. I get rid of that down year, and all of a sudden I've got a number that's uncalculable. So I'll take one more year out since 2011, if you will. And this has a March fiscal year. This company's been growing at 24%. So here we're seeing a PE equals growth rate. The orange line is a PE of 24. The blue line in this case is a PE of 23, which simply is suggesting that they've converged. In other words, the normal PE and the intrinsic value PE are essentially identical, and you see how the stock price has perfectly tracked that. On this basis, looking at history, the stock looks just minorly undervalued at this point. It was a little overvalued back in 2018. It got very attractive in at the end of 2018, and it's looks undervalued again. But again, we have to look at it from the future. Now, since valuation was pretty much in line here, if I look at historical performance over this time, once again, this is outperforming the S&P 500, averaging almost 19%, and you can always attribute that to valuation. It started out a little overvalued on the basis of this historical growth, ended up a little undervalued, and that's why instead of 24%, rate of return, we've got 19. But if I even take 1 year off of that, actually I'm going to take 2 years off of that, see if I can get closer. Yeah, now here I've got 21.5% growth. I've got a smidgen of undervaluation and a smidgen of overvaluation. Now I'm getting a 24% rate of return. This is how valuation works. Valuation enables you, empowers you maybe is a better way of saying it, to participate fully in the growth of the business. Now, they've only been paying a dividend for a short while. Also notice that. So this is a growth stock. Going forward, the stock is expected to grow at 15% long term. For the next year or two, the growth rates are expected to be 15%, followed by 10 and 12. So on this basis, it would look overvalued. I think that's important to mention that, you can learn from history and see how well this company did, but you're always buying the future. Now, the question is, are these analysts understating what the future might be? Let's check Yahoo and see what they're saying for the long-term growth rate. Yahoo thinks the next 5 years are going to be closer to 26%. Now, that's significant because if I go into the forecasting calculator here and go into the custom calculator, and I'm just going to put 27% using a round number, using Yahoo's number, and that changes the picture dramatically. Now, the problem is somewhere between those two numbers is probably the truth. It's up to you to do your own homework and due diligence and decide whether you think Electronic Arts is going to grow in excess of 25%, or they're going to grow at the rate that the analysts at FactSet expect at about 15. Somewhere in between that's probably reality. But anyway, I like Electronic Arts. I do think it does have a lot of growth. I might like to, if I was buying it for myself, buy it a little cheaper, but it certainly looks attractive. Take-Two Interactive. By the way, Electronic Arts, they own some of the most well-named franchises also. They own the FIFA, I don't know if it's pronounced FIFA, the biggest soccer organization in the world, Madden football, Battlefield, and, they're big into sports and big into some other games. Take-Two Interactive is the one that has the Rockstar Games. The company has two major publishing labels, Rockstar Games and 2K. That's the company we're covering right now, which operate internal game development studios. One of the largest and well-known video game franchises it owns is Grand Theft Auto. Most of us, even me, I've heard of that. And through its subsidiary, Rockstar Games. The other and extremely popular franchise, NBA 2000, is its largest annual franchise and the most popular sports game in both the United States and China, I might add. And over the last 20 years, Take-Two has made the transition from a publisher dependent on Grand Theft Auto into a publisher with multiple franchises across gaming consoles and PCs with recurring revenue streams like Colt was talking about. And you can see the big surge in growth since about 2011. So I shortened this time frame and, try to come up with a calculable number here. And we're starting to see 16, 17% growth. And if I go to the 10-year growth, we're seeing almost 35% growth. So again, there's some cyclicality here, but very fast growing company. Long-term trend line growth from FactSet is expected to be 12%. The numbers over the next year or so, we are expected to see a down year, which might be the instigator of why this company's seen some, negative performance here recently. Again, check this with Yahoo estimates. Always try to get a second opinion, if you will. Yahoo thinks the next 5 years are going to be 12% as well. So, the 3 to 5 year growth rate is expected to be about 12%. You might want to buy this stock a little cheaper, but it's certainly one of the premier companies in the industry if you can buy it at an attractive price. The next one is Zynga. And Zynga is an interesting company. They develop, market, and operate social games as live services played on mobile platforms, such as the iOS, Apple iOS and Android, and social networking sites like Facebook. They generate revenue through mobile game downloads, in-game sales of virtual goods, and advertising services. Zynga's revenue is divided between online game and advertising and other, where online game accounts for the vast majority of the company's total revenue. Zynga's gaming portfolio includes CSR Racing 2, Empires and Puzzles, Farmville, Merge, Dragons, Words and Friends, Mafia Wars, Zynga Poker, and Treasure Out. So, it's an interesting company. And again, you can go through Fast Graphs, you can go into these companies' websites, and you can look at, some of the games that I was talking about here, and you can see what the company offers and, the types of products that they provide their, subscribers or gamers. Growth rate has been kind of, again, inconsistent, but it's grown very fast in the last several years. Forecast to only grow at about 7% over the next 3 to 5 years. And again, we're expecting a down year here. So this is one that is, starting to drop in value, and there's perhaps good reason why based on what the analysts are expecting going forward. And then last but not least is the, China-based NetEase company. And real quickly, if I go into their website, you can look at some of their products here. Let me translate this to English so that we can see what it is. These are, some of the games they have. This is probably the one I'm least familiar with. But what I did find interesting about this company was the fact it has some of the best fundamentals. This is their second quarter 2021 investor presentation. This is the kind of research you need to do. Their market snapshot, they're 60 billion market cap. They have 3.4 billion shares outstanding. They give you some net income numbers. They talk about their recent business highlights. I'm not going to bore you with this today, but you can go here and learn about the company. Their revenues and gross margins have been moving in the right direction and so on. So it's a very interesting stock, and it grew and had tremendous performance. We've had this really big correction in the stock. And if I look at it from the standpoint of 3 to 5 year expected growth, this is from FactSet, they're expecting just under 21% growth, which would make this very attractive. With growth stocks, you don't need the margin of safety if the company delivers the growth, because the power of compounding is what really makes these growthy stocks attractive. Let's just check Yahoo real quick before we go on. Yahoo's expecting the next 5 years to be only 3%. Now that's interesting because here you have, we've had FactSet giving kind of I'll call it weaker numbers, with the Reuters people giving much higher estimates. Here you've got the FactSet guys giving, and by the way, there's only one analyst in this universe, so this is one analyst's opinion. The actual specific estimates for the next couple of years are in the 22% for this fiscal year, coming, which closes again in December, and then 14%, 14 and 17. So we've got about a 16.79% average, which makes it interesting. And again, if the stock trades at normal PE ratios that the market has historically applied, which then does tend to put premiums on these growth stocks, you got a 19% potential. But there is risk here, and there are, these are things that you would want to look at, a lot closer when you're doing your due diligence. Now, what I do want to go through these things, I do want to look at them, at these companies from a sales point of view. Okay, I'm going to go through all these very quickly. Now, I don't have updated pricing here, but I'm actually going to take pricing off of the graph here. And what I want you to just really note here is the direction of the sales of these companies. Here's Take-Two. Here's Nintendo, and this is one of the issues with Nintendo. Sales have exploded here coming into 2021, but now are expected to drop. That's based on the estimates. If I look at Activision is expected to continue with strong sales growth going forward. Zynga is expected to have nice, consistent sales growth going forward at a pretty hefty rate, I might add. If I look at NetEase is expected to grow at sales at about 14 or 15% a year. So when you're looking at these companies, there's Roblox, which I mentioned doesn't really have any historical fundamental data. So these are all interesting gaming stocks. I hope you got a little insight into them. They're not necessarily my cup of tea because I don't really play them. I'm not really into them, but they are part of what I'll call the modern culture. Certainly, a lot of young people play these games and like them. I know Colt's played the games in the past, and I really appreciate him coming by and sharing with us some of the insights into how this industry works and how the businesses are monetized, et cetera. Anyway, this is the gaming industry. I hope you enjoyed it. As always, if you did, give us a like and a thumbs up and ring the bell and subscribe to the channel if you haven't already. This was our take on the gaming sector. Thanks for watching.